Yeah, what'd you make of this reversal higher today, concentrated in the Nasdaq stock? Did it have any significance for you based on the levels we reached or the response to those levels?
Well, the Nasdaq 100 was right on some important support around 15,575. And the fact that it managed to close above that level today is a good thing. It means it was a successful test of that support level. And also, we like to see closes right near the highs of a big volatile day like today. So it's an incremental positive. We've been calling for the mega caps to kind of kick in here very near term and generate a relief rally or oversold bounce for the major indices. But we're also recommending to perhaps use that to reduce exposure, because we have seen a pretty meaningful loss of momentum behind the major indices. I don't think that's lost on anyone. And yet we have some spots of strength and weakness. So it's really become a bit of a bifurcated tape.
So mega cap tech set for a rebound, it sounds like. What is your call right now, Katie, on energy after it seems like we've front loaded a lot of gains here in the beginning of the year, the best performing sector?
Yeah, I mean, it's wild. The S&P 500 energy index up more than 10%, and also the financials index up more than 5% just year to date. So really impressive gains there, and certainly they do reflect positive short-term momentum. We're recommending folks hold their existing positions, but we're not recommending adding new exposure, even though those are the two sectors that are really the source of the breakouts over the past couple of weeks. The reason we're not recommending adding new exposure is because we are watching really the macro front, which would be crude oil prices as they come into resistance from October, roughly $82 per barrel. We really need to see a good breakout above that to foster positive intermediate term momentum beyond what we've already seen from the energy sector. And for the financials, it'd be great to see 10-year Treasury yields get above this very major resistance, which for me is right around 1.79%. And by that, I mean it spends a couple of weeks above that key level. It's based on previous peaks, but also a 50% retracement level that holds some importance in our work. If we do see that cleared, which ultimately we think will happen, the targeted level for the 10-year Treasury yields becomes about 2.13%. Certainly, that would dictate more overweight positioning in the financials at least.
So you think ultimately we do get above this sort of 179 area in the 10-year? Does it have to kind of pull back first, do you believe? We obviously stalled right in that area today.
I mean, it's a very natural place for them to stall or consolidate. They are overbought based on our measures from a short-term perspective, but only short-term. So with the upside momentum behind them now with this up move, we do think a breakout will follow some consolidation. That consolidation could last maybe 2 weeks or so and nicely would be aligned with the potential for those mega caps to kick back in. As you know, technology did really underperform so far year to date, down almost 5% for the S&P 500 names. So with a relief rally there, you could see some consolidation develop in 10-year Treasury yields, and then that relationship just shifts right back to where it is now.
That is the focus of the market these days. Katie Stockton, we'll leave it there. Thank you for joining us from Fairlead.
Thank you.